let's also look at this data points. I just try to see the calendar year beginning and end of the Sensex from 2001, right? Now, if you look at this, what is surprising is there is only 4 times where the markets gave a negative return. Of course, 3 times here on the screen itself. And the next slide when I show, it will be the 4th time. Yeah. So in the 21 years, only 4 times market had been given negative return. And major correction was 2008 and then 2011 calendar year. And of course, after that, we had a small correction in 2016. Now, the point here is somebody might look at this slide and say, boss, what happened to 2020? March 2020, you said 30-40% correction. Just see, by December, it recovered. And we got almost 15.6% return. Yeah, after 30-40% correction, year ended with almost close to 16% return. So why I'm showing this data is very important that yes, market correction will happen. At the same time, recovery also happens. Maybe it took more than a year last time around the big correction, 2008. Whereas this time it recovered within that year, it's not even 9 months. That's where I said we can never forecast how much time, what percentage, right? This is something which we have to accept. As an investor, when I'm investing in, be it in a direct equity, be it in a mutual fund, what I need to accept is those corrections are bound to come. So that is where we need to be clear what kind of volatility you are willing to accept. You can never say that my NIV cannot be volatile. So all those things we'll see as we go forward. So I thought I'll also show you the data points along with whatever crashes has happened. And as I mentioned, the most important lesson is we have to accept that yes, crashes are going to come. And we don't know when and what percentage it will come, right? That is one important lesson we have to keep it in mind. And other factor also, though it is not related to crash or something, what we also need to understand is, I said market will recover, right? How much time it will take, we don't know. But what actually drives the market is, whenever the economy is not doing well, RBI will actually start cutting the rates. That's why I was showing you this repo rate from almost 2000 till now. This is a good indicator to understand where the economy. For example, when March 2020 Corona came, all of us knew economy is going to get hit. And that's where RBI immediately jumped into it and cut the rates drastically. We brought down the repo rate to 4%, which is the lowest so far. US repo rate unimaginable, 3.35. What it means is people are able to borrow at these repo rates. That is the biggest plus. Second is, why I'm saying this is, we also need to understand the economy if you want to understand how the markets can be. Yes, markets will react to the events. But in the long run, as I was giving the example of Japan couldn't recover because the economy was down. So that is where it is very important to know how the economy also works. So today, the very fact RBI is keeping the policy as accommodative means they are still not clear whether the economy has revived. Which means what? I mean, the interest rates are going to be low, which is very good for equity. When RBI changes the policy and try to increase the rates, that's where slowly the negative impact on equity will happen. Why I'm saying is somewhere we also need to understand was what is that I should expect from equity today. I can't go by somebody saying you will get 15% return, 12% return. No, I can't go by that. I need to understand where my account. That's why today we are all talking about a 5 trillion economy. We are close to 2.8 to 3 billion economy. Now, trillion I'm saying. Now we are looking at 5 trillion economy, right? If that is the target, then you can understand where the market. So in the long term, markets will always deliver based on your economy is doing well or not. So I just wanted to touch that relationship. That's where the next slide is also talking about economy and Sensex. It's simple. Basic logic is what? Unless the companies make profit, your economy will not do well. The companies has to make profit means all this demand, supply, everything has to be addressed. And if the interest rates are low, people will invest in or put their capital into their business, and that's how the business will grow. So if all this is happening, obviously your GDP will grow, right? So that is where we have to track the economy also if you want to understand how the markets will behave, right? Corrections can come for various reasons. Absolutely no clue. Tomorrow something happens to Modi ji, market will correct. Something else happens to the US president, market will correct. Some policy changes happen, and in any case, budget is coming now. Something against the public, then market will correct. All these are not in our hands. We cannot predict that, right? But we can understand how our economy is doing, right? That's where some amount of discussion with your advisor should always happen regarding the economy also. Try to understand how the economy is behaving, because in the long run, that is what will drive your markets. Yeah, be it the downside or the upside, it's related apart from the events which are coming. Yeah. And the best way to manage this volatility, we keep saying this, right? SIP is the best way to manage this volatility. There is no other tool, honestly. There is no other tool to manage volatility. Either you put lump sum, then stay with it for that period and try to make money. You don't want to take that kind of volatility, then SIP is the best. Why I'm saying this is, you can see in this chart, as on March 20, all the categories of our mutual funds, equity funds are negative as of March, right? 31st March. But as of 31st December, when the markets recovered, this entire negative return of 12% has become positive 12%. Which means what? Literally, I earned around 25% return in that 9 months time. So that's where these negative returns will be part of your portfolio. We have to accept. Second fact is that is one lesson we have to again learn. What many people do is they'll immediately go and stop the SIP. If I put in bank, I would have got this return 4%. Here it is minus 12%, right? 3-year return is minus 12%. Yeah. Now, if you go by that, you would have withdrawn the money. You would have missed that 25% return from there on. So the best way to manage volatility is SIP. Don't stop your SIP. That is a message we want to give here.